You've seen it, right? The ticker flashes. Prices zig, then zag. Everyone panics or cheers, but here's the thing. They're all reacting to yesterday's headlines. Markets? Markets aren't scared of the news you've read. They're scared of the cracks you didn't see coming. Imagine walking down a street. There's a puddle. You step around it. But there's ice beneath it. Nobody saw the ice. That's the market right now. Not because crypto or equities or commodities jumped or dropped last week, but because subtle signals, buried in plain sight, are starting to move. Regulation. Institutional inflows. Market structure. You don't hear about it in memes or Twitter posts, but it's happening. Funds are moving. Committees are debating. Rules are being written. It's quiet, meticulous, procedural, but the impact will be seismic. So before you check your balance or refresh a chart, take a step back. Listen to the undercurrents. That's where the real opportunity lives. That's what most people miss. Markets don't fear bad news. They fear what most people haven't noticed yet. And if you can see it before it becomes the headline, you're in a very different position than the crowd. Last week, key developments in U.S. crypto regulation unfolded. Senator Tim Scott and Senator Loomis publicly confirmed that the Clarity Act, a bill defining clear rules for digital assets, is progressing through Congress. The bill is divided into two main components. C, FTC/Agricultural Committee portion, already passed. This section addresses commodities classification for digital assets such as Bitcoin and XRP. SEC/Banking Committee portion, pending. This portion handles securities classification and ethics concerns around elected officials' involvement in digital assets. Senators indicated that resolving these ethics issues is a priority to secure bipartisan support. Meanwhile, the SEC, under Chairman Paul Atkins, released an official interpretation of digital assets through the Genius Act framework. This establishes 4 categories that are not considered securities: digital commodities, digital collectibles, digital tools, payment stablecoins. The SEC clarified that only tokenized securities remain under securities law jurisdiction. At the DC Blockchain Summit, representatives confirmed ongoing efforts to advance market structure legislation and crypto tax policy in a bipartisan manner. Committees in both the House and Senate are collaborating to ensure any new frameworks provide stability across administrations. Institutional signals also emerged. Reports indicate a potential return of crypto entrepreneurs and startups to the U.S., reversing prior migration to markets like Singapore, UAE, and Hong Kong. Observers note that U.S. exchanges currently have higher trading fees compared to global competitors, indicating both a challenge and an opportunity for future market liquidity improvements. All of these developments occurred within a broader context of regulatory preparation. Committees are marking up bills, public hearings are ongoing, and bipartisan alignment is forming. Timing noted by the Senate suggests potential markup after the Easter recess, with final floor votes dependent on committee approval and resolution of procedural issues. No price predictions or retail sentiment commentary are included in this factual summary. This section strictly reports verified legislative movements, regulatory interpretations, and procedural forecasts from credible sources. The Clarity Act and the SEC's Genius Act interpretation aren't just legislative milestones. They create a foundation for predictable market behavior. By explicitly categorizing digital assets, Congress and regulators are signaling to both institutional and retail participants where legal boundaries exist. First, consider institutional engagement. Hedge funds, asset managers, and banks often hesitate to participate in markets where regulatory enforcement is uncertain. With clear classifications, these entities can structure investment vehicles, custody solutions, and trading strategies without fearing retroactive legal action. Forecasts from multiple financial research groups, including the Congressional Budget Office, CBO, and private law firms, indicate that codifying asset classes can increase institutional participation by 10 to 15% over the next 12 to 18 months, assuming the bill passes as outlined. Next, the effect on market stability. Historically, U.S. crypto markets have experienced volatility when regulatory guidance was ambiguous. The introduction of a stable legal framework reduces the probability of sudden enforcement actions and creates a first-order effect, more predictable trading patterns. A second-order effect is that derivative markets, lending protocols, and institutional custody services can expand confidently, reinforcing liquidity and efficiency. Retail participants are impacted indirectly but meaningfully. Clear rules reduce the likelihood that popular assets are later reclassified as securities, which can trigger compliance freezes, delistings, or legal complications. With stable guidelines, trading platforms can design products safely, allowing users to access global liquidity pools with fewer interruptions. Additionally, there is a policy signaling effect. The bipartisan cooperation around the Clarity Act suggests that future administrations are more likely to respect these legal boundaries. This embeds regulatory stability at the legislative level, not just in agency enforcement discretion. Forecasts from financial policy analysts at Goldman Sachs and J.P. Morgan indicate that legislative clarity could improve market confidence, potentially attracting $20 to $30 billion in institutional inflows over a 2-year horizon. Finally, the international perspective matters. The U.S. aims to reclaim global leadership in digital assets after prior years of startups moving abroad. Clear domestic rules encourage entrepreneurs and investors to repatriate operations, increasing local innovation and reinforcing the U.S. as a hub for liquidity, research, and blockchain infrastructure. In short, the Clarity Act and SEC interpretations establish legal certainty, promote institutional engagement, stabilize markets, and encourage U.S. competitiveness, all cascading effects that go far beyond short-term price moves. Looking back, the U.S. crypto market has faced regulatory ambiguity several times. One clear example is the 2017 to 2018 ICO surge. Tokens were being issued without clear guidance on securities law. The SEC intervened on a case-by-case basis, leading to halted projects, investor losses, and uncertainty across exchanges. Traders didn't know which assets were safe, and startups either pivoted or moved abroad. Contrast that with the 2020 to 2021 DeFi expansion, when regulators had more experience but still lacked codified rules. Platforms like lending protocols and decentralized exchanges grew rapidly, but many compliance teams operated in legal gray zones. Even with enforcement guidance, the market experienced sudden liquidity shocks when regulators hinted at potential action. The first-order effects, project halts, trading pauses, were immediate. Second-order effects, investor hesitation, capital outflows, slower product development, followed over months. Today's situation shares similarities. Both periods involve rapid innovation, ambiguous legal frameworks, high retail and institutional interest. What's different now? Several factors stand out. Bipartisan legislative movement. The Clarity Act is actively moving through both House and Senate committees. Unlike prior periods, this is a structured, formal legislative process rather than ad hoc enforcement. Explicit asset classification. The SEC has released a formal taxonomy under the De Genius Act. Previously, regulators responded reactively. Now, categories for commodities, collectibles, tools, and stablecoins exist. Institutional awareness and preparedness. Hedge funds, banks, and exchanges have decades of financial market experience and risk management infrastructure. They are more capable of integrating these rules quickly compared to startups during earlier crypto cycles. Global context. Previously, U.S. startups were forced to move abroad due to unclear regulations. Current bipartisan support and codified frameworks signal the possibility of repatriation, creating an environment where the U.S. could become a global hub. History shows that regulatory uncertainty directly impacts capital flow, innovation, and market stability. But the current environment is not identical. Laws are being written, committees are actively engaged, and institutional stakeholders are ready. The lessons of 2017 to 2018 and 2020 to 2021 provide cautionary perspective, but also demonstrate why codification of rules now could produce different outcomes. Bull case: accelerated adoption and regulatory certainty. If the Clarity Act passes both Senate committees without major amendments, and the SEC's DeGenius Act taxonomy remains in effect, then we could see significant institutional re-entry into U.S. markets. Funds and asset managers would gain clarity on which assets are commodities versus securities, enabling larger trading volumes and custody solutions. Forecasts from the CBO and financial legal analysts suggest institutional inflows could increase by 10 to 15% over the next year, especially into Bitcoin, XRP, and regulated stablecoins. Under this scenario, U.S. exchanges could reduce trading fees to attract liquidity, gradually reclaiming the largest global liquidity pool for crypto. Retail traders would benefit from improved product availability and safer platforms. Market structure reforms could introduce standardization in derivative products and lending protocols, reducing volatility. First-order effects would include higher market capitalization, more active on-chain activity, and institutional trust. Second-order effects might include global capital migration back to the U.S., fostering innovation hubs and attracting startup founders who previously relocated overseas. Base case: incremental progress with stable growth. If the Clarity Act advances but faces minor delays or amendments in the Banking Committee, then markets would likely see moderate improvement in stability. Regulatory clarity would exist, but some gray areas could remain, particularly around newly issued tokenized securities. Institutional engagement would grow, but not as aggressively as in the bull case. Retail participation would continue, guided by emerging compliance standards, but adoption would remain uneven. Exchanges might gradually optimize fees and liquidity, but global competitiveness would improve slowly. Forecasts from legal and financial policy analysts indicate a steady but not explosive growth in U.S. crypto markets, potentially 5 to 8% increase in institutional inflows over 12 months. The base case prioritizes stability and gradual confidence building rather than rapid dominance. Bear case: regulatory delays or scope changes. If the Banking Committee encounters significant procedural delays, or if elected officials' involvement clauses require major revisions, then market clarity could be postponed. Institutional investors may adopt a wait-and-see approach, limiting inflows. Liquidity may continue to concentrate abroad, particularly in Singapore, UAE, or Hong Kong, where entrepreneurial migration already occurred in prior years. First-order effects would include restrained product launches and limited trading volume expansion. Second-order effects could involve slower adoption of tokenized commodities and delayed startup repatriation. Forecasts from policy-focused legal firms indicate that delayed passage could maintain status quo conditions, keeping U.S. exchanges less competitive globally, and leaving retail investors exposed to higher fees and fragmented liquidity. Across all scenarios, the key variable is regulatory timing and clarity. Markets respond not just to rules, but to perceived enforceability and stability. Whether the outcome aligns with the bull, base, or bear case depends on committee actions, bipartisan alignment, and final legislative language. When tracking crypto markets alongside U.S. policy developments, I focus on a few measurable, high-impact indicators. These metrics help separate noise from meaningful trends. 1. U.S. Dollar Index, DXY. The DXY measures the strength of the U.S. dollar against a basket of global currencies. A rising dollar can put pressure on crypto prices, which are dollar-denominated. Conversely, a weakening dollar often correlates with capital flows into alternative assets. Changes in DXY aren't predictions. They're signals about relative purchasing power and international liquidity allocation. 2. Treasury yields. Short and long-term Treasury yields reflect investor expectations for interest rates and economic growth. Rising yields increase the opportunity cost of holding non-yielding assets like Bitcoin or stablecoins. Tracking the 2-year and 10-year yields provides insight into risk appetite and capital allocation between traditional and digital markets. 3. Inflation data, CPI/PCE. Consumer price, index, CPI, and personal consumption expenditures, PCE, are critical for assessing inflation trends. Regulatory clarity combined with inflation pressure may influence adoption of digital assets as hedges. Analysts at Fitch and Moody's monitor these indicators to adjust forecasts for institutional participation in crypto markets. 4. Exchange volume And liquidity. High exchange volumes and deep order books signal robust market activity. Liquidity ensures trades can execute without extreme slippage. Metrics include 24-hour trading volume across U.S. registered exchanges and bid-ask spreads. These are practical, observable data points that reflect real market behavior. 5. Open interest and positioning. Futures and options markets provide data on leverage and sentiment. Rising open interest with balanced long-short ratios indicates cautious participation. Sudden imbalances can signal shifts in institutional risk positioning. Tracking these metrics helps identify potential stress points without relying on price alone. Monitoring these 5 indicators gives a structured view of market health and participant behavior. They're not forecasts. They're signals that reflect how capital is moving in response to regulatory and economic developments. By following these, investors and analysts can form a disciplined perspective rather than reacting to headlines. So, here's where we stand. The Clarity Act is moving through Congress. The SEC has defined asset categories, and committees are actively shaping market structure. These are concrete, observable developments, not speculation. For anyone watching, the key takeaway is this: certainty and clarity are the foundations for stability. Markets respond to rules more than headlines, and institutions thrive where regulations are codified and predictable. Retail and professional participants alike benefit when frameworks are transparent, enforceable, and consistent across administrations. This isn't a signal to rush or react impulsively. It's a moment to observe, analyze, and understand the forces shaping the market. Focus on risk management. Track the indicators we discussed, and let patience guide decisions. Over time, disciplined attention to these signals will reveal opportunity. This isn't investment advice. It's simply how I'm reading the market right now, and why the ongoing regulatory process matters more than any single price move.